Welcome students. So we are discussing the process of issuing the shares in the market and about the different types of the share capital, that is authorized capital, issued capital and subscribed capital. Now we will be talking about that is the called up capital. So I was talking to you in my previous discussion that first installment is the application money. So 2 rupees will go with the application and remaining 8 rupees now the company has to ask for. So 3 rupees they are asking with the allotment and remaining 5 rupees will be asked for, 2.5 rupees under first call and 2.5 rupees under the second call. So now they are asking for this, and in this case the total amount of 10 rupees have to be paid by the people. So the shareholders, they have to pay that total 10 rupees. So here in this case 3 rupees with the allotment they have to pay. So 20 rupees they have already paid, somebody has got the 10 shares, so he has already paid 20 rupees and 30 rupees he is going to pay when he is allotted the shares. He receives the allotment letter and he has to pay for the 30 rupees for 10 shares. So we assume that the total number of shares out of the 10 crores at the rate of rupees 10 this are going to be 1 crore. So it means when people receive the allotment letter, so company is asking for, so called up money will become now 5 rupees per share multiplied by the 1 crores, it will become 5 crores. Company is going to receive till the completion of allotment process, company is going to receive 5 crores and remaining 5 crores will be received later on under the first and the second call by 50% under the first call and 50% under the second call. So here total say for example we talk about the allotment money, and in the allotment money people who have been asked, total shareholders, 1 crore shareholders have been asked to pay 3 rupees each. So it means company want to collect 3 crore rupees. Here some people say decide that though I have applied for the shares, 10 shares, maybe one person is there who may say that I have applied for 10 shares of this company, I have given 20 rupees, I have got the shares also, now the company is asking for 30 more rupees and then they will be asking for 50 more rupees for the remaining 2 calls, and total I have to pay for the 10 shares, I have to pay 100 rupees. So he may change his mind at the later date. He may say that I applied, that was a different scenario, but now when I got the shares allotted, I am not interested to carry on as the shareholder of this company. I do not want to continue as the shareholder of this company. Now what he can do? He can choose not to pay the call money, allotment money. He has paid 20 rupees, but when he has received the allotment letter and company is asking him to pay 30 more rupees under allotment, he may choose that I will not pay the allotment money and I am not interested in the shares of this company. So he will not send the allotment money. So why this? The total amount company is asking is, they have already received 2 crores with the application. So 2 crores they have received with the application, they are asking for 3 more crores and with the allotment, but out of this the shareholders worth of the capital of say 20 lakhs, they may decide that we will not continue to be the shareholder, we do not want to continue to be the shareholders of this company, we do not want to continue as a shareholder of this company, it means. And when the allotment money, sending the date for the allotment money was over, by that date company received here 2.8 crores, 2.8 crores of rupees, 2.8 crores of rupees. It means 20 lakh rupees means 20 lakhs say divided by the 1 share of 10 rupees and 3 rupees per share. People holding that much a number of shares, they have decided not to pay the allotment money. So company didn't receive against the total demand of 3 crores. company received only 2.8 crores and company didn't receive 20 lakh rupees. So it means that much number of shareholders decided not to continue as the shareholder of the company, and we don't want to pay. We have wasted 2 rupees with the application, no problem, but we don't want to pay remaining 8 rupees, we don't want to pay remaining 8 rupees. So my 2 rupees are gone, I am okay, but I don't want to pay 8 more rupees because I don't think this is going to be a good investment. I don't think this company is going to be a very viable organization. So he will decide like that. So in total worth of 20 lakhs allotment money was not received by the company. So till now against the demand of 5 crores, company is going to receive, or company has received is how much? 4.8 crores. 4.8 crores, 4 crores and 80 lakhs the company has received. It means there is a shortfall and default. Because of the default, company has not received the 20 lakhs. After that, company carries on the process, and after receiving allotment money, utilizing it for some period of time, company asks, during that 1 year, company asks for the first call 2.5, and 1 month after the company asks for the second call. So in total means company is asking for the remaining 5 crores also at the interval of 1 month. So they are asking for the 5 crores, remaining 5 crores. They are asking for the remaining 5 crores. Now against this demand of 5 crores, there may be another set of shareholders who have paid the application money, who have paid the allotment money, but at the call money stage, they decide in total for both the calls that shareholders means worth of investment of another say 30 lakhs, another of 30 lakhs, total capital amounting to rupees 30 lakhs. At the time of call from company for paying the call money, first and second call, shareholders having the shares worth 30 lakh, they now decide that we also don't want to continue as the shareholders of this company. It means we have already paid them 5 rupees, 2 rupees on application and 3 rupees on allotment per share. So that money is already gone. I have already paid 50%. That is gone down in the drain. I'll forget that. But I don't want to pay my remaining 5 rupees. So 50% my loss, okay, but I don't want to make it a loss of 10 rupees because this investment is not going to be a viable investment. So I will not pay the remaining. So this way, total number of shareholders, or for the number of shares, people decided not to pay the calls money in total, comes up as 30 lakh rupees. So against the total demand of 5 crores, now the company is going to receive how much? That is 4.7 crores. 4.7 crores. It means total till the end of a year, company will be receiving 9.5 crores and capital worth 50 lakhs will not be received by the company because shareholders at different stages, some at the allotment stage, some at the first call stage, some at the second call stage, they decided not to continue as the shareholder of the company. Forget my 2 rupees or forget my 5 rupees or forget my 7.5 rupees. I can save 2.5 rupees, I would like to save. I have paid 7.5, maybe people who dropped at the level of the second call, they had already paid 7.5 rupees, but they want to save, they don't want to pay the remaining 2.5, so they wanted to save that 2.5. So the total amount works out as 30 lakhs. So this company has not received. So in total till the end of the year or that total period during which that share money was asked by the company is going to receive now, or finally the company has received 9.5 crores. 9.5 crores. So it means company will be, here it is saying that under different installments how the company asks for 2 crores here, 3 crores here and 5 crores here, company asks for 10 crores. So the called up capital will also become 10 crores. Called up capital is also 10 crores. But how much people have paid them? People have paid them only 9.5 crores. 9.5 crores. So, this is how the 5 types of the capital is divided and described. We have authorized capital 100 crore, with which the company is authorized to be, the company has been registered and company is authorized by the registrar of companies to raise during its foreseeable life. Out of that, company decided to raise 10 crores from the market under the first issue, that is first IPO, and shares means 1 share of 10 rupees, and for issuing 1 crore shares in the market, company gave the advertisement and completed the process. Then, so that means the issued capital became 10 crores. Then the subscribed people applied for the shares, 1 crore shares worth 10 crores at the rate of rupees 10 per share. It means the subscribed capital also became 10 crores. Then over the different installments and calls, application, allotment, first call, second call, company asked for at different intervals for 10 crores, that became the called up capital, and finally 9.5 crores worth of the capital was received by the company, and shareholders holding the shares worth of 50 lakh share capital, they decided at different stages not to pay the remaining balance of the money. Somebody decided not to pay the allotment money, so he lost 2 rupees per share. Somebody decided not to pay the first call, so he lost 5 rupees per share. Somebody decided not to pay the second call money, so he lost 7.5 rupees per share. So finally the shareholders worth of capital of 50 lakhs, they refused to pay the subsequent calls. So it means finally the company could get the capital, collected, that was 9.5 crores. So there is a shortfall of the 50 lakhs, because a new company, people don't know about it, and people are not interested to carry on as a shareholder or continue as the shareholder of the company. So they have decided not to pay some money at some stage, and this way the company has not been able to get 10 crores against the 10 crores demand call. It means the company has been able to get 9.5 crores against the call of 10 crores. So this is how we talk about the different types of the capital. So when you will be preparing the balance sheet of the company form of organizations or joint stock companies, we don't need to show all kind of the capitals in the balance sheet. At least this authorized capital and paid up capital, these two capitals should be there. These two capitals should be there in the balance sheet, so that everybody knows that when this balance sheet will be reported to the different stakeholders, government, tax authorities, shareholders, or maybe any general public, anybody in the general public, when they will be given the copy of the balance sheet, they get to know that the company is authorized to raise 100 crores in its foreseeable life. First issue came for 10 crores, and against 10 crores the company has now got the paid up capital of 9.5 crores. So these two capitals have to be shown in the balance sheet, authorized capital of 100 crores and the paid up capital of 9.5 crores. This 9.5 crores will become now the final share capital of the company, with which the company will carry on the business, and this will be shown in the balance sheet. So this is the share capital of 9.5 crores and different types of the capitals and how they are to be divided. Now before we start preparing the financial statements, I will discuss with you certain other important concepts which are important here, that is different types of the shares. Different types of the shares. Largely we have two broad categories of the shares which the companies in India can issue, or the companies are allowed to issue in the market. These shares are preference shares, and equity shares. Preference shares and equity shares. These are the two broad categories, preference shares and equity shares. Preference shares, why they are called as preference shares? Because they get some kind of the preferences. They get some kind of the preferences over the equity shareholders. When somebody is holding the preference share, he will be getting some preference against his equity counterpart, That is why these shareholders or people subscribing to these shares are called as preference shareholders. Now what are those preferences which they get? These preferences are, first preference, normally they get two preferences. First preference is that at the end of the year, when the company will calculate its profit or loss, and a company has a sizable amount of the profit, sufficient profit, and company want to pay the dividend, then the first right on that dividend will be of preference shareholders. So first preference is in terms of the payment of dividend to the shareholders. When the companies declare the dividend, first right on that dividend is of the preference shareholders. So this is the first preference they get. But here the rate of the dividend remains fixed, that is pre-decided. When that preference share is issued, it is written on the share certificate that, say for example 10% or 12% or 15%, whatever the dividend company want to pay preference share, or 12% or 15% preference share company want to issue or sell in the market. So it means 10% preference share means the rate of dividend is 10%, 12% means the rate of dividend is 12%, 15% means the rate of dividend is 15%. So they will be paid the dividend at the pre-specified rate which is written on the share certificate, and at that percentage nothing more nothing less will be paid by the company to them as a dividend to these shareholders, but they will get the preference over their equity counterparts, and this is the first preference. Second preference is the return of capital. Return of capital means when the capital is returned by the company, for example company is dissolved, is broken down, company is dissolved because of any reason, maybe the objective with which the company was created is over. So now the company does not want to carry on the same business, or company's business prospects are not good. So it means same company under the same business objective they do not want to continue, or because of any other reason, or the company is not able to carry on the business, the financial health is not good. So when the company is dissolved, is broken down, has to be removed from the existence, at that time if some, by selling the assets of the company in the market, if some capital is there, what will happen? First the assets, all the assets, land, plant, building, machinery, furniture, patents, everything will be sold in the market. After selling those assets in the market, whatever the sale proceeds will be available to the, say you can call it as in the hands of authorized person. He will settle the claim of debt suppliers, say for example financial institutions, they will be paid first. Then for example bond subscribers or debenture subscribed, they will be paid after that. After that still some capital is left then, and that has to be returned now to the shareholders. So first right on that receiving the capital first of all will be of the preference shareholders. So this is the second preference they get. First preference they get in case of getting the dividend, second preference they get in case of getting the capital back if because of any reason, if the company has to be closed down, dissolved, and the capital has to be returned back to the shareholders. First claim on that is, first right on that capital is of the preference shareholders. These are the two preferences they get, but against these two preferences they have some disadvantages also. What are the disadvantages? That number one, the rate of dividend is fixed, whereas it is not the case with the equity shareholders. Equity shareholders, if there is a high amount of the profit, then the equity shareholders may sometimes get 50% of the dividend also. But if there is no profit, then equity shareholders, or there is a less profit, equity shareholders will not get any dividend, they do not have any right on the dividend. But if there is a huge profit or the company's say performance is very good, in that case equity shareholders stand at a gain and the preference shareholders stand at a loss, because the dividend to be paid to the preference shareholders remains fixed. This is the first disadvantage. Second disadvantage is these shareholders, preference shareholders, have no voting right. They have no voting right. They cannot vote on any particular issue. Say for example, at least as per the Indian Companies Act 1956 and then the amendments further in 2013, at least once in a year every company is required to, obliged to call a general meeting of shareholders, all the shareholders, that is called as AGM, annual general meeting. Annual general meeting, they are companies required to call of all the shareholders and explain to the shareholders about the affairs of the company, how the company is running, how the company's business is going on, what are the future plans and prospects. Everything is shared and explained to the shareholders at least once in a year. It can be more than once also, but minimum once in a year AGM is must. Annual general meeting of the shareholders is must. Now for example, in that case the management of the company has decided that they want to diversify the business of the company into a new direction and into a different direction, and they want to take up the new projects. And then in that case some of the shareholders are in favor of taking up those projects and some of the shareholders are against taking up of those projects. So for example, situation becomes that now the company has to go for the voting, that let us see how many people vote for the in favor of that decision of the management, how many shareholders vote against that decision of the management, and in that situation preference shareholders can be the mute spectators there. They have no right and they cannot vote. Only equity shareholders will have the voting right and they will be asked to vote in favor or against that decision of the company of diversification, and preference shareholders have no voting right. So some disadvantages means two disadvantages, that the rate of dividend is fixed and no voting right, and two advantages, preferences, that yes, dividend will be given to them at a preference, and if the capital has to be returned they have the first right against their equity shares counterparts, equity shareholders or the equity shareholders holder counterparts. So these are the two broad categories of the shares, preference shares and equity shares. Now we have furthermore say subdivisions of the preference shares. We have furthermore subdivisions of the preference shares. These subdivisions are, means the preference shares are of the four category. Preference shares are of the four category. Now we will be talking about the preference shares. First is cumulative and non-cumulative preference shares. Cumulative and non-cumulative preference shares. Second category is convertible and non-convertible preference shares. Third category is redeemable and non-redeemable preference shares, and fourth category is the participating preference shares and non-participating preference shares. These are the four categories of the preference shares. Cumulative and non-cumulative preference shares, as the name indicates, cumulative. This cumulation or accumulation is in relation to the dividend. Say for example, company has issued 10% preference shares, and if they are cumulative preference shares, in that case what will happen? If say in one particular year company has no sufficient profits and company decides that this year no dividend will be paid, so equity shareholders will go without dividend, but the preference shareholders, because they are cumulative preference shares and they are 10% cumulative preference shares, so this year no dividend is being paid, so their dividend payment will keep on accumulating. Next year for example, the company has sufficient profits and company decides to pay the dividend to the shareholders, preference shareholders, and if they are cumulative preference shareholders, in that case they will get the dividend at the rate of 20%, not at the rate of 10%, because the dividend of the previous year and the current year has accumulated, and now they will be getting double amount of the dividend. So it means, for example, till first cumulative shares are issued for 5 years, preference shares are issued for 5 years, and for example for the first 4 years company has not got the sufficient profits and they have not declared any dividend. So in the 5th year they will be paid dividend at the rate of 50%, 10% each for the first 4 years, and 5th year that will be 50%, but normally that is not allowed to happen. So normally it can happen in the 1 year the company has no sufficient profits, so 2nd year they are going to pay the dividend. If they are cumulative preference shares, then they will be paid the dividend for the current year as well as for the previous year. And if it is a non-cumulative preference shares, in that case dividend will be paid at the fixed rate of 10%, and only in which year the company has the profits, sufficient profits, and company's management decides, board of directors decides that they are going to pay the dividend to the shareholders. So they will pay the dividend for that year only, current year only, nothing for the previous year, because they are non-cumulative preference shares. Then second category is the convertible and non-convertible. Convertible preference shares are those shares which can be converted into equity shares. Normally preference shares in India are issued for a period of 5 years. So after 5 years, even both the sides want to continue with the preference shares, it is not possible. Either they have to be redeemed, means the shares have to be purchased back, bought back by the company, and the money has to be paid back to the shareholder. And if shareholders do not want to get the money back, and even the company also does not want to return the money back, in that case the shares can be, preference shares can be converted into equity shares. And when preference shares holders will become equity shareholders, their all rights and responsibilities will be of the equity shareholders, their all preferences of preference shareholders will go, and all demerits will also go, and all merits and demerits of the equity shareholders will be having all those merits and demerits of the equity shareholders. So they will become the equity shareholders of the company, and as good as the other existing equity shareholders are, they will also be the equity shareholders of the company. After that we have two more forms, that is redeemable preference shares and non-redeemable preference shares, and then the participating and the non-participating preference shares. So these two types we will be also talking about, knowing about, learning about, discussing about, but that I will be talking in my next part of discussion. Thank you very much.